Welcome to the AI Research Roundup. I'm Alex. Today we're looking at an article titled Canaries in the Coal Mine 6 Facts about the recent employment effects of AI, and as we'll see later, the implications for the labor market are quite significant. The standout finding is clear. Early career workers in the most AI-exposed occupations saw substantial declines, with software developers aged 22 to 25 falling nearly 20% from their late 2022 peak to July 2025. Stick around. The patterns by age and task type tell a nuanced story. In brief, overall jobs kept growing, but employment stagnated for 22 to 25-year-olds. Declines concentrated where AI looks automotive, wages barely moved, and the results hold across many robustness checks. Alright, the previous figure highlighted broad exposure patterns, and figure 1 shows the time paths by age within two occupations. The top chart tracks software developers, where headcount for 22 to 25-year-olds drops sharply after late 2022, while older groups hold steady or rise, which signals disproportionate entry-level cuts. The bottom chart covers customer service, showing a similar split. Younger workers decline, while mid-career and senior groups trend flat to higher. The vertical dashed line marks late 2022, so the divergence aligns with post-GPT adoption. Moving on, the previous figure showed sharp entry-level declines in highly exposed roles, and figure 2 contrasts that with occupations of varying exposure. The top left panel for marketing and sales managers shows modest dips for younger groups but no collapse, which suggests partial exposure without wholesale displacement. The top right panel for first-line production supervisors rises steadily across ages. The bottom left panel for stock clerks trends up uniformly. The bottom right panel for health aides climbs most strongly, so entry-level workers keep pace rather than falling behind. Okay, the previous figure compared occupations by exposure, and figure 3 shows headcount trends by age group split into less versus more exposed quintiles. The early career panels display a clear break after late 2022 because more exposed 22 to 25-year-olds dip, while less exposed peers hold roughly flat. Middle-age groups rise steadily with only slight differences, which suggests limited displacement. Seniors continue to grow, so exposure gaps narrow with age, and the pooled red line tracks modest overall gains. Well, the previous figure emphasized exposure gaps across quintiles, and figure 4 shows normalized headcount over time by age group across all occupations. All groups rose through late 2022, which the vertical dashed line marks, but trends diverge afterward. Early career 1, ages 22 to 25, levels off and then dips slightly, while mid-career and senior lines continue to climb. The pattern implies aggregate employment kept expanding, so the stagnation concentrates among the youngest workers rather than being economy-wide. Alright, the previous figure showed aggregate trends by age, and figure 5 breaks growth into exposure buckets by age band. The blue bars, which reflect less exposed quintiles, show positive growth across ages, while the orange bars for the most exposed quintiles turn negative for 22 to 25-year-olds. Middle and older groups remain positive, even in high exposure buckets, so overall growth comes from older workers. The green bars, aggregating all quintiles, sit between the two, which underscores exposure as the key splitter. Figure 5 breaks growth 0.06, 0.07, 0.95, 0.80. Well, the previous figures summarize growth by exposure buckets, and figure 9 reports event study coefficients by age across exposure quintiles. The top row for ages 22 to 25 shows clear negative shifts after late 2022 in higher quintiles, which signals sizable relative declines. Rows for ages 26 to 30 and 31 to 34 look near flat, so effects weaken quickly with age. Older groups show small, mostly insignificant moves, indicating that the displacement concentrates among entry-level workers. Wrapping up, 2 takeaways stand out. Early career workers in highly exposed roles saw meaningful employment declines after late 2022, while overall jobs kept growing and wages stayed mostly flat, suggesting adjustments occurred through headcount rather than pay. The broader implication is clear. Automative AI adoption risks narrowing entry paths. That is it for this episode of the AI